Howdy there, folks. We're going to listen to Paul Tudor Jones here. I just got done watching this. Very interesting. So Paul Tudor Jones, we're going to listen to his reasoning. But basically in this video, this gentleman says that not only should you not be buying stocks right now, but basically you shouldn't even be holding stocks, okay? Now, this is very, very intriguing. And the reason this is really intriguing is, first off, like who is this guy? Like, why should we even care about kind of his opinion? Paul Tudor Jones has a net worth of about $7 billion. It ran a hedge fund. Now, to be fair, he made a lot of his money, it seems, back in the 80s, okay? And it seems like in the 2000s, he hasn't necessarily done great from what I could find on him, okay? But nonetheless, the guy's worth $7 billion. He's obviously been in the financial markets for a long, long time. So it's at least worth kind of hearing what he has to say in regards to this, right? Now, when it comes to someone like him, the reason I like to pay attention to these is I like to see what do they say, okay? And the reason being is a lot of times people will try to just like disregard all this and like not even look at it. And I kind of think it can lead to more fear and panic if you keep trying to put this stuff to the side and you're not at least willing to like hear people like, what are you saying here? And then you can kind of break it down and you realize it's not as scary. It's kind of like as a kid, you go in a dark room, right? You go in your bedroom and it's dark and you're kind of scared. It's better to just to get over that fear rather than keep like, pushing it down the road, because eventually that comes back to bite you, right? And so we'll listen to what he has to say. I'll give my opinion. One thing I will say right off the top here is when you're in a bear market, which we're in the bear market on the NASDAQ and the Russell right now, a pretty vicious bear market that is, right? It's very easy to say, don't hold stocks, sell stocks. It's kind of like yelling fire when there's already a fire going on, right? These are much harder statements to make when, let's say, for instance, you're in a great market, right? And people are making money, right? It's like, where were a lot of these statements back in October, November, right? And what you're going to find is these were very few and far between. It's much easier to yell fire when there's a fire going on versus a situation where you haven't seen the fire and you're like, I think there's going to be a fire essentially, okay? Now, like I said, the market's vicious. I think everybody knows that, right? Down huge, on this particular day. I want to share some thoughts on this in just a moment here from my private Discord chat. But let's listen to what he has to say. Also, FTX US, thank you for sponsoring today's video. I'm going to tell you guys a little bit more about FTX a little later in this video and why you should definitely sign up for FTX. All right, let's jump into this.
You could either be a fly on the wall, but maybe more importantly, a whisperer, a Fed whisperer. What would you be telling Jay Powell right now?
Oh, I'd be saying, look for another job. I think this is one of the most challenging periods ahead for the Federal Reserve Board in its history. And it's certainly something that I don't know if we've ever navigated anything like this. Certainly not in your lifetime or Becky's lifetime with the other codger Joe on this group. He probably remembers it like I do because I think he's my age. But we've just never seen anything like this since the 70s. So it's really uncharted waters. I like to think of it as a crosshatch ocean. You know how normally in the ocean you'll have one swell that moves one direction? Occasionally you'll get a situation where you have one swell moving in one direction and then another swell coming cross-hatch, and it creates this impression of squares in the ocean. So imagine trying to navigate that when you're in a boat where you're dealing with the swell this way and this way and this way and this way, and that's what we've got right now.
So first off, just as, it sounds like pretty scared. You know what I mean? Like that's the best way I could kind of describe his commentary there, is pretty scared about, the Fed and this whole situation, trying to
What is the captain of your ship, that you're the captain of it? How are you navigating it? Meaning, to the extent that you're setting up your portfolio to try to get around these swells, what are you doing?
It's really hard. Normally I've got a lot of very strident ideas on things. It's really hard. I'll give an example. So if you look at how much financial conditions index has tightened just in the last month, the only other times that it's tightened this much, and just to remind everyone, financial conditions index is a composite of the stock market, the dollar, credit spreads, and it's a very good indicator of the general strength of the overall economy, a good proxy for it. So it's moved so much in the last month. The only other two times I think that exceeded it were in Lehman Brothers in 2008, as well as in March of 2020. The other times since they began
By the way, both those times were great opportunities to buy in the market. Both those times were great times, like the fall of 2008, great time to buy in the market. Market didn't bottom for a few more months. Do keep that in mind. But that was a phenomenal time to buy. And obviously March of 2020 was an amazing time to buy stocks too. So I'm not saying that like this time is the exact same and this is a great time to buy stocks, but it is important to remember both those times were.
That index back in 1980 was 81 and 82. Right after the crash of
80, as the 80s went on, it was a very good decade for stocks.
87. Right after 9/11.
Right after 87, really good time to buy stocks. The crash of 87, he just said. So that was a really good time to buy stocks. 9/11 after that, pretty good time to buy stocks. NASDAQ was still a little shaky back then, but there was a lot of stocks that did really well after that time period.
I think twice in 2002 towards the bottom of the bear market, and then three times in 2008, and then March of 2020 during the pandemic. So
basically every single one of those times was a tremendous time to buy stocks. So that's an important thing. And that's why, Paul Tudor Jones, he says something like this, right? But you got to understand every single one of those times was a great time to buy stocks. And in all those situations he just went over, there were great times to buy stocks. There was a lot of stocks very, very discounted. So that's something to keep in mind. Once again, it doesn't mean this is a great time to buy stocks right now in 2022, but every single time he just named, dang, man, you bought stocks, you made out like a bandit.
So every one of those instances were all associated with cuts, Federal Reserve Board cuts within 24 days on average, literally some of them within 2 or 3 days. Now, all of a sudden, we've got the same kind of reaction in the markets, which is clearly a risk off. Credit spreads have blown out. Stocks are down 13% in the year. The dollar's up significantly.
NASDAQ's down over 22% year to date. Russell's down a little less than that, but Russell and NASDAQ are both bear markets, just so everybody knows. S&P 500 as of today, down probably almost 14% year to date so far.
All that normally has provoked or evoked a Fed response of cutting rates, and yet we're probably on the cusp of 200 basis points of rises in rates by mid-September. So it's uncharted territories where we're going. And
but do you look at that?
Hold on. Let me make a point here. So first off, I would like to take a moment to thank FTX US, which is the official crypto partner of the channel, for sponsoring today's video. If you have not used FTX US and signed up for it yet, you're definitely going to want to check out pinned comment. And here's why, essentially. FTX allows you to invest the most simple and easy way possible out there, with fees that are up to 85% cheaper than competitors. You can track all your cryptocurrencies. Also, the news tab is absolutely phenomenal through FTX US, where you can keep up with all the different news out there in the crypto community, and there's always a lot of breaking news out there. So one of the things that many FTX users love about the platform is the fact that you can set up recurring buys. So let's say every 2 weeks you want to buy a certain amount of a certain cryptocurrency, you can do that through FTX. So make sure you sign up for FTX. Check out the pinned comment down there, and make sure you use my referral code, which is Holy Smokas, to get free cryptocurrency when you place trades through the app and make deposits. So definitely enjoy that. Check that out. Everybody's assuming like the Fed's going to do certain things. The Fed has said they're going to adjust as they go along, right? And so let's imagine a scenario where the rate of increase in inflation starts coming down. The Fed will adjust to that, and they will not be as aggressive. If obviously the rate of increase of inflation continues to go up and up and up, and all of a sudden we're at 9%, 10%, that's a different scenario. The Fed's going to continue to be more and more aggressive in that scenario. So it is important to remember that the Fed can adjust, and this is something Powell said yesterday. They're going to continue to adjust. They're going to monitor the situation. inflation. And at the end of the day, the Fed's going to try to do everything in their power to keep employment full, right? Yes, they want to bring down inflation, but I think inflation is going to take care of itself pretty much no matter what as we go into the back half of this year. That's my personal opinion. We'll see obviously how all that plays out, but the Fed's job, they want to also, keep employment obviously in a healthy place as well. So that is something always to kind of keep in mind there.
And say to yourself that a recession is coming? Do you say everything's on sale, I got to buy things? Do you say that I got to short this market? I mean, I know you say you don't have a strident view, but you must be telling
look,
your traders
clearly
to do
you don't
something.
want to own bonds and stocks.
Clearly, you don't want to own bonds and stocks, he just said. So, I mean, basically that's a statement of you shouldn't own bonds and stocks. That's literally what the man just said, right? First off, the timing. That's timing of the market, right? You're talking about not owning bonds and stocks, especially when they're going through a tough time. That's basically saying you're trying to time the market from a perspective of like sell out of stocks, right? It's a tough thing to do when you're already in a bear market for the NASDAQ, right? Doesn't mean it can't go down more. Always can. Always can, right? And we've seen in some vicious markets where S&P ends up falling 30%, 40%, 50%. And that's always a possibility, right? But that's a tough thing to tell folks to try to time this market out. Don't own stocks, don't own bonds. It's a very, very tough thing, and especially in a time period you're going through where there's lots of inflation, which we all see it right in front of us, right? So, when there's a lot of inflation going, your dollars are being devalued, right? And so that's a tough thing, to say don't own stocks, don't own bonds. You don't want to own those right now. It's like, ugh. And then that's also giving kind of the message of not buying when it's scary. And what we do know is usually you're going to make out like a bandit over time if you essentially buy when there's a lot of fear in the market. And dang, there's a lot of fear in the market. We looked at the AAII investor sentiment recently. Last week, it was among the most bearish we've ever seen in history. Okay? One of the most bearish times we've ever seen, and one of the least bullish times we've ever seen in the market. So these are things to obviously consider.
That it's going to be a very, very, a very negative situation for either one of those asset classes, right? You can't think of a worse macro environment than where we are right now for financial assets. And again, one of the reasons, I think maybe the biggest differentiator between now and those other periods over the past 40 years is look at the level of overvaluation that we were both in rates as well as stocks. So that's one reason why even with this tightening in financial conditions, the Fed still probably has to raise rates to get inflation under control. Heck, we had CPI greater than 8%. Maybe it comes down to 4% this year. Maybe it comes down to 3% if they stay the course and stay tight in 2023. If you've got inflation greater than 3% on average, your purchasing power declines, cuts in half in 13 years. It's why I wish we could go back to those halcyon days of sub 2% inflation when you didn't have to worry about the value of your money. You didn't have to worry about what you were doing with regard to pay raises, and you didn't have to worry about a whole pricing and a variety of things that all of a sudden become that much more important. And trying to, again, just have a normal business that you have to think about when inflation's 3% and higher, and you don't have to think about when inflation's 2% and under.
Be careful what you ask for, Mr. Paul. You might just get it, and next thing you know, you got deflation. Let me pull you up something here for just a moment. All right, what I have you up here, because he mentioned about valuations of stocks, things like that. Okay, first off, I agree with him in the respect of, large cap stocks were obviously massively overvalued. Mid cap stocks were massively overvalued, and small cap stocks were massively overvalued. Okay, now when it comes to large cap, they were mainly overvalued, kind of in the beginning part to middle part of 2021. Same exact thing with mid caps, kind of a little more into the back half of 2020. Same thing with small caps. Okay, this is forward Ps. Now, the one thing I will say, and I don't even think this takes into account today's drop. I think this was as of this morning before the big drop. But large caps are in line with kind of where you would expect them, kind of in the 15 to 18 range. Mid caps are insanely low right now, and small caps are just off the charts low, right? And so something important to remember is a lot of the, let's call it, past overvaluation you saw in the market, a lot of that has gone bye-bye now, okay? And so that's something important to keep in mind, right? I wrote this for the private stock group, I don't know, maybe an hour ago or a couple hours ago. I said I was just doing some thinking about who is hurt most in the market like this. Not a lot of folks think about this. I'm 32 years old. I'm down multi-seven figures in the past 7 months. That sucks, but at the end of the day, I'm 32 years old. Not planning on retiring anytime soon. I'm happy to buy the dip and the cheaper stocks, and the cheaper I buy stocks, the more my long-term gains will be. I would say the average age in the private groups, maybe mid-30s. We have some folks that are in the 20s, 40s, 50s. However, most are in their 30s. From what I have seen, the vast majority of you guys aren't considered retiring for 10, 25 years. I would say the lower stocks go, the more shares you get to buy, the more ownership of companies you get, the more money you're going to make long-term. The folks that are really hurt in a major way are folks that who recently retired or are planning on retiring soon. Think baby boomers. They already got hit in the housing crisis 15 years ago. Think about it. Imagine you had $1 million in a retirement fund at the beginning of this year. You now likely have 800,000 to 875,000. Retirement funds are usually S&P 500 and bonds. Both have been a disaster. The bond market's a whole mess that I'm not even going to get into, obviously. If you are already retired, you can't buy the dip since you have $0 of income. Retirees are also usually on fixed income, so inflation hits them very hard. The only thing those folks have going for them is mainly if you own a home, right? Many of those folks do own a home, and real estate's been really strong. If that were to fall, you get the trifecta. For everybody reading this right now, remember this time period we're going through. Someday you're going to be near retirement. Keep this in mind, okay? And so I just kind of wanted to kind of give those words out there because, in this sort of market, that's the folks who are really hurt the most, okay? That's the folks that are really hurt the most in this sort of market or folks that are in retirement or about to retire. And, because they can't buy the dip. They can't buy the dip, especially if you've already retired. And I know there's a lot of people that have retired early because stocks were doing so good and the market was doing so good. And most folks have a lot of their net worth tied up in the market, right? In real estate as well. So those have done tremendously well. But if all of a sudden you're taking that away, that can be pretty vicious pretty fast. And for, those of us that have jobs, right, and you have more income than expenses, you get to buy the dip. And, whether the market dips for another month, another 3 months, another 6 months, another 9 months, another 12 months, another 24 months, which is completely unrealistic, but you never know, okay? And in the market, you always say you never know, right? Whatever time you get to buy this dip for, right, you get to continue to buy. If you're retired, you don't have income. You can't literally buy the dip, right? So you have to just kind of sit there the whole time it goes on, like seeing your account balance go lower and lower and you're never able to buy cheaper, right? And so for those of us that are able to be in this situation, right, we're able to continue to buy shares. And however long it goes down for is however long it goes down for. And then as the market starts going back up, we're able to buy as well. So it works out great for us. But for folks that are retired, this is kind of worst case scenario. And especially if you're close to retirement age, all of a sudden when your account balance keeps dropping, next thing you know, you're like, I think I might work a few more years, because the numbers aren't quite there like they were before. And so that's the baby boomers, unfortunately, are the ones that kind of, they do get hurt the worst in this whole situation. There's no doubt about it. If you're young, it doesn't matter. You get to buy shares for cheaper. That's just the bottom line. For everybody that's, under the age of 50 watching this right now, the best thing that could ever happen to you is we go through a multi-year bear market. The worst thing that can happen is like stocks just go to the moon and then you're never able to buy stocks for, relatively cheap pricing, right? And right now we obviously have really, really cheap pricing on stocks and we could get even cheaper. And so I look at it as, it sucks to see your account balance down. You're down, 5 figures, 6 figures, 7 figures, multi-7 figures like me, right? And a lot of other big investors in the market. But at the end of the day, it's just like get to buy more and more shares for cheaper prices and I get to increase my ownership bigger and bigger. That is what it is, okay? So anyways, guys, hope you enjoyed this. As always, let me know your opinion on what Paul Tudor Jones said there. Love to hear from you guys as always. Make sure you check out FTX. That will be the pinned comment down there. And don't forget to use my referral code, which is Holy Smokers. Much love and have a great day.